Yes, Siri, and thank you very much for your introduction. And good afternoon, everyone. Thank you for joining us today. In my previous webinars, I was talking about how to get financing in order to fulfill your life goals and dreams. Today, we're going to talk about how to protect it. So the word insurance means to insure that God forbid something happens to you, a borrower, it will take care of the borrower's financial plans and obligations. There are many type of different insurance coverages, and each of them has its pros and cons. But today we will talk only about creditors insurance. So creditor insurance will pay for the loan if something happens to the borrower if the loan is loan fully repaid. Creditor insurance is usually available as a part of the group insurance policy rather than individual policy. So group policies are generally less expensive than individual type. So the lender here is the owner and beneficiary of the group policy, and the borrower is the insured. So if you're the borrower and you want to get coverage, so you are insured. Why creditor insurance is important? Most of us definitely carry some debt. So for a house or a car or whatever, vacation, or even the credit cards. So, and when life goes as plans, these debts fit in your budget nicely. It's when something unexpected happens that debt can become an issue for us. So that's where the creditor insurance comes in, and it helps to prevent your loan from becoming a burden to you or your family. And here how it works and why you can be it would be a smart way to help protect yourself and your family. So we're offering protection for 4 type of life events. So life insurance pays for eligible outstanding balance of the term loan, line of credit, or mortgage in event of insured person's death. So it basically pays the whole thing. Disability insurance pays the eligible monthly payments for a term loan or mortgage, also pay 3% on the eligible outstanding balance of a line of credit on a monthly basis. So it's basically making payments for you when you suffer and you recover. And critical illness insurance pays the eligible outstanding balance. It's the same way as the life insurance, but in event, so you're still alive, but the member is diagnosed with a covered heart attack, stroke, or cancer. So loss of employment insurance pays the eligible monthly payments for a mortgage in event our member loses the job due to involuntarily layoff. So the Ukraine Credit Union is offering optional credit insurance on mortgages, loans, and line of credit. That's 3 different plans and programs. And if those loans are financed through our credit union. So our creditor insurance is underwritten by Cumis Insurance. It's a division of cooperators. So why insure your loan, a line of credit or mortgage at all? So why creditor insurance is so important for us? Because it protects, first of all, it protects your credit or future borrowing power. If you become sick or injured or unable to make your loan payments, your credit score will not suffer if you have a coverage. So 1 or more past due payments can lower your score, which could affect future borrowing power and the loan interest rates. So the worse your credit, so the higher interest may be if you ask for the loan. It also helps prevent delinquency and repossessions, which can damage your credit report as well. So if you're a new borrower, building your credit rating and future buying power is very important for you. Payment protection allows you to continue to build these important financial elements in the event you become sick or injured or unable to make your loan payments. It also protects your family. They won't be burdened with the debt in the event you become sick, injured, or pass away. If you get sick, payment protection allows you to focus on recovery from your illness and injury without having to worry about your loan payments. This coverage also provides peace of mind for your family and will eliminate your protected debt should you pass away. It also protects other insurance coverage. So some people have coverage through work or privately. Uh, so those coverage can do whatever they meant to do, and it takes care of the basic living expenses. Because when you get that insurance, you had something in the mind you want to protect financially, and this coverage will can do what it's meant to do: take care of your mortgage or loan. Credit Life Protection will pay off the insured loan balance and protect your other life insurance policy in the event of your death. So your wife, husband, or children will inherit the asset instead of inheriting liability. Payment protection supplements your coverage through work and will help fill the gap financially. So most employers plans pay between 60-70% of your salary if you're off work due to illness and injury. So these work plans are designed to cover basic living expenses, and payment protection is designed to cover your loan payments. It also protects existing savings and retirement assets, so you won't have to tap into your RSPs or RIF, whatever you have, which earmarked for retirement and other savings that you work hard to create. This coverage also provides security for your family if you pass away. So your family would not have to worry about using assets to make those loan payments. Your savings that you have been building for years can do what is meant to do and send your children to college, and this coverage, what it meant to do, just pay the loan. Payment protection allows your money to go further. Whether you have an emergency health fund or life insurance policy benefit through your employer, payment protection will provide one last payment for you and your family, which helps to free up money to pay for unexpected and unplanned expenses. It's also affordable. For only a few bucks per day, your personal assets and family financial future is protected from the different risks that come with it. New debt obligations. Payment protection offers the convenience of easy enrollment and take just a few minutes. So it's not like, loan underwriter. So you just answer a few questions, sign the paper, it's done. For the personal loan, the line of credit loan less than $50,000, there would be no health questions at all, no medical testing. So what this means to you is that you can take advantage of immediate coverage and affordable group rates to help protect your loved ones and your financial well-being. Your signature, that's all it needs. For monthly premium or mortgage protection, only it's to enroll in payment protection. It's easy to enroll as well. So the cost is paid monthly via pre-authorized payments for your convenience. There are limited health questions. It's just, I believe, 3 questions we ask. So they only need to elect your coverage, sign in your name. You will be immediately protected. It's that easy. It will help to maintain your family standard of living. If you're on a reduced income due to illness or injury, that prevents you from working for a period of time. So you may have to make certain sacrifices. Payment Protect will make your insured loan payments, assisting you family to continue lifestyle they are accustomed to. So payment protection makes insured loan payments easing your budget at home and helping prevent financial hardship. So this coverage also protects you from loss of life so that your family would not burdened with this debt. So your children can go to college, continue their piano lessons, and maintain their lifestyles. In event you suffer a job loss, your insured loan payments will be made for a period of time, allowing you to maintain your standard of living. You can use your EI benefits, employment insurance benefits, for what it's designed to do, cover your basic living expenses. That coverage can do what is intended to do and take care of your loan, allowing you to focus on finding new employment instead. It will ease your stress and worry and help prevent financial hardship. So you may focus on recovery from illness or injury that may prevent you from working for a period of time. The stress and worry over how to cover my monthly loan payments will not be in your mind. Being off work due to critical illness or reduced income can be very, very stressful. So insured loan is protected with the payment protection. So what this means is you won't have to worry about making these loan payments, and your insured loan will be paid off and you can concentrate on your recovery instead. Payment protection protect your collateral and assets from repossession and foreclosure. So your house or your new family vehicle and other assets which you provided as a collateral will be protected. Should pass away, payment protection will pay you off the remaining insured vehicle loan or mortgage balance. So the clear title vehicle or the house now become an asset for the family rather than liability. Critical illness protection on your house or vehicle loan will pay off your insured loan balance in event you're diagnosed with cancer, suffer a heart attack or stroke. So what this means to you is your family will inherit a clear title vehicle rather than continue with the debt obligation. It's also protect your co-signer or guarantor from assuming your loan payments which they have not planned or budgeted for. Help secure the financial well-being of both you and your co-signer. Because sometimes you ask somebody to co-sign because you don't qualify either on the income or your credit history is not that great. So your co-signer would not to have to make those payments which they never planned to making because they thought you would be making those payments. And your co-signer would not left with the debt if you were to pass away. And we had those cases. So the co-signer co-signed, the main borrower passed away, and guess what? The co-signer or guarantor is now responsible for the loan. They never had it. They just helped the friend or the relative. And it will protect your investment. On reduced salary due to illness or injury, you may find it difficult to cover your monthly debt obligations. Payment protection will cover your insured loan, protecting your investment, your down payment, or equity in a property you made toward your house or the recent vehicle purchase. So you don't have to sell it because you cannot afford to pay those payments. And usually it happens in the worst market. So you have to sell it for a lower price that you would sell if you sell it on the high market. And life is unexpected. Events can happen anytime. So it's weird to some statistic on the screen. 25% Canadians will develop critical illness before retirement because we always think, oh, it would never happen to me. No, statistics says 1 in 4 Canadians will have it. And 61% Canadian have no coverage on inadequate life insurance coverage at all. So 1 in 3 people will be disabled for 90 days or more, at least once before they reach an age of 65. Think about these numbers. How would you pay your bills in the event of family tragedies such as a job loss, critical illness, sickness, accident, or death? We offer affordable protection, peace of mind from the financial hardship of these unexpected events. Getting a mortgage is a big long-term financial commitment. Whether it's buying a condo or refinancing for your forever home, protecting your investment from life curveballs can help provide you with peace of mind for less than you think. Mortgage protection can help you in the event you lose your job, become disabled, or diagnosed with a critical illness, or if you die. So remember the statistics, 1 in 3 people will be disabled. So disability, you can get the coverage up to $3,000 per month for a maximum 24 months per claim. But again, the mortgage is 25 years and people sometimes get sick, so they claim, they get well, then in time they can get sick again, so there will be new claims. So every claim, so how many claims you can have during the time of the mortgage? So many times. So it's a very good deal. So life and critical illness, it's available up to $1 million, and it pays outstanding insured balance of your mortgage as the date of critical illness diagnosis or the date of death for life insurance. And loss of employment, as I mentioned, that's it. It would pay up to $3,000 per month for a maximum of 9 months per claim. So it's basically, it pays the same way at the unemployment insurance. And you get both unemployment insurance and the loss of employment. For the loan protection, the life and critical illness is available up to 90,000. Loans always lower, and it pays outstanding insured balance on your loan as of date of critical illness diagnosis or the death for the loan life insurance. And you get disability. It pays up to $1,500 per month for a maximum of 72 months. So it's 6 years per claim. And even the best laid plans, life can throw curveballs. Big ones like a critical illness, disability, or sudden death can leave you or your loved ones in a tight spot to try and make payments. Line of credit protection can help make your monthly payments or help pay off your debt when you can't. So you remember, 1 in 4 Canadians will develop the critical illness before retirement, and you can have the coverage up to $1 million, and it will pay outstanding balance, and you can get disability up to $3,000 for 16 months, and it covers the line of credits and home equity line of credits. So remember, credit protection is optional. Coverage is governed by terms and conditions of the creditor group insurance policy issued by the creditor and is subject to term conditions and exclusions and eligibility requirements. So for more details, you can ask at any of our branches the product guide and certificate of insurance for full coverage details. So to talk to any of Ukraine credit union lenders today about how to add creditor insurance to your mortgage, loan, or line of credit. So thank you very much. And if you have any questions, I would be happy to answer them. Thank you.
Thank you, Vlad. And like I said at the beginning, if you have any questions, please type them into the chat box. First question is, if I already have disability insurance coverage from my employer, do I still need to think about getting it on a loan?
Yeah, definitely. As I mentioned in my presentation, so most of the disability from your employer or you buy privately would cover the 60-70% of your income which you had before you became disabled, and it's barely covers your basic expenses. Usually, if the person becomes disabled, the income falls down. Probably your loved ones, your family should take care of you, so their income would suffer too, so they cannot work overtime or whatever they do, or sometimes they have to leave the job to take care of you. And most of the companies, what they do, they will deduct the payments which you receiving from anywhere else from the benefits they paying you. In case of creditors protection, it's paid directly to your loan. It's not paid to you, so it's not considered your income at all. So you're not including your income tax, you're not including anywhere, you're not declaring it to other insurance companies. So you get both, because in terms of if it's not and it just insurance, that will be deducted from your payments. So that definitely makes sense, because mortgage payments or loan payments, they pretty high, and probably it's the biggest payments in your budget. So to have it covered, it definitely makes sense. Thank you.
And if you have critical illness insurance and you do get critically ill, how long does does it pay the entire loan off, or does it pay it for a certain amount of time? How does that work?
So basically, yeah, as I mentioned, that's a 3 deadly disease, which the critical illness covered is a heart attack, stroke, and cancer. So basically, if you diagnose with the covered events, so the insurance company basically will pay the whole balance of the loan. If it's mortgage, it's free of mortgage. So instead of like worrying, oh, I'm sick and I'm dying, so what my family would do, and they have such a debts left after me, it will be fully covered. You have no debt, and you can concentrate on your recovery. So definitely it makes sense.
And you don't have to die from the heart attack. You
Oh,
just
no.
have to get it.
And yeah, so if, let's say you diagnosed and you got your coverage and then you survive, everything is great. So the treatment was successful. You don't have to pay it back. It's gone. So you have no mortgage or loan or balance of the line of credit. It's gone, and you can live with no debt.
So if I feel like getting a heart attack, I'm gonna put you on speed dial and get insurance between the time I get taken to the hospital and.
Yeah, but yeah, it's some conditions, and as I mentioned, yeah, you need to read the product guide and certificate of insurance. So what kind of, so it really has to be a terminal disease. So it's not like, just a little bit dizzy and I want my mortgage to be paid. No, but it's a serious heart attack or stroke or cancer case.
Okay, and then if I decide to get the coverage for a loan and then I change my mind, how easy is it to, can I cancel it, or do I have to?
Yeah, so basically, in general, you can cancel insurance anytime. But another thing, you have 30 days, 30-day cancellation free look for the insurance. So if you decided, okay, I want to get coverage, you got it signed up for, you sign everything, the coverage started, but then you kind of talk to your family, you calculated, discussed with somewhere else, with your financial planner, and you decide, no, really, I have enough money to cover my losses, so I want to cancel. So if it's done within 30-day period, so it will cost you nothing. So no premiums. If you pay premiums, it will be returned to you. So it's a 30-day free look. Or if it goes over 30 days, then you can cancel anytime. You just come and sign cancellation, and that's it. But the premiums, which you paid already, yeah, it's not going to be returned to you.
Okay, well, thank you very much, Vlad. I think that's it for the questions. So thank you everyone who joined us, and we'll see you in the new year when we've scheduled some new webinars.
Okay, thank you.
Have a great day. Bye.